Hi, this is Brian Resney. It's question and answer day. And one of the questions that comes up often, especially in a low interest rate environment, is about bonds, specifically high yield bonds and bond funds. In fact, one of the questions I recently received was from an investor who had about 70% of his money invested in various high yield bond funds. Basically, let me explain what a high yield bond is or a high yield bond fund. These would be non-investment grade or riskier bonds of less stable corporations. They typically pay a little bit higher rate. Today, the average high yield bonds paying between 4 and 6%. So what's happened is, as rates basically have come down and the economy's gotten a little bit better, high yield bond valuations have gone through the roof. So what happens is this: high yield bonds act very similar to equity prices or stock prices, meaning if you remember 2008 and 2000, high yield bonds and bond funds actually dropped as much or more than the stock market did. So while people think high yield bonds are less risky or safe, they're not. In fact, if I look at valuations today on high yield bonds and bond funds, they're at the highest valuations I've seen in decades. And remember, I've been managing money for 28 years. Extreme valuations. I would look at high yield bonds kind of like internet stocks back in the latter part of the 90s. A lot of risk, very little reward. In fact, what I would say, if you're a high yield bond investor or you own high yield bonds, this would be the perfect time to sell those high yield bonds. You have very little upside potential, very low rates at this point, and huge downside potential if the economy actually does falter down the road. I would rather look at equities in a portfolio than high yield bonds today. You can still get a dividend, you have upside potential, but you have reasonable valuations on most equities, whether small, mid, or large, versus high yield bonds and bond funds, which are extremely stretched. Again, I see a lot of investors who use brokers, brokerage firms, so-called advisors. They're sold these investments because they're stretching for yield. The broker doesn't know much more than the investor does. They put you in these investments. You're taking a lot of risk. So if you own high yield bonds in your portfolio, you might want to second think your portfolio, or better yet, call our firm for a consultation. There is a difference. We invite you to experience it. Have a safe and profitable day.